Welcome, everybody. My name is Scott Parsons with Delta Strategy Group, a consulting firm in Washington, D.C. I want to thank everybody for attending this webinar and thank ErisX for hosting. This is regarding some recent guidance that the CFTC put out on digital assets and how FCMs are to treat digital assets, which there's been a lot of questions, a lot of interest in this topic. And so ErisX has brought together some experts from the accounting side as well as the legal side, and you'll hear views from both of those sides on this guidance, as well as some recent AICPA guidance that relates to this, and then also from the business side. This event is being recorded, so if we don't get all the questions answered by the time this is over, we'll do our best to answer them and have it sent out to all the participants who can watch it again or get those questions answered. I want to thank all of our participants, and I'll briefly introduce them, and then we'll jump right into the content. First, Tom Chippas, CEO at ErisX. Todd Briggs, a partner in the financial services group at the accounting firm RSM. His colleague, Jay Schulman, principal blockchain and cryptocurrency practice at RSM. Gary DeWaal is a special counsel and chair of the financial markets and regulation at the law firm Katten. And you'll hear from all of them very shortly. Tom, I think I'll also invite people to, if you have questions while we're going through this, please submit those in the Q&A, and we'll get to them as we can. We've already had a lot of questions emailed to us in advance, so we'll jump right in and get them in the order that they are received. Tom, I guess I'll start with you. You have been heavily involved in working with the CFTC, as has your team, on the events that led up to this guidance. And so I'll start with you and just say, why is this guidance necessary?
Thank you, Scott, and thank you to everyone that's attending, and thank you to the team at ErisX that did so much work with the commission and various other parties to get this advisory the daylight that it needs. Why is it needed? Obviously, ErisX as a DCM and DCO is really proud to have listed physically delivered futures on our market and really pushed the boundaries, for example, getting things like the first physically delivered Ether future and what have you. But from day one, we've always wanted to build a market that is accessible both to retail directly, but also to traditional channels of market access. And in the case, of course, of derivatives, that's via intermediation by FCMs. And in order for FCMs to offer these types of products, it's less about the pipes and plumbing, which we can take people through, but there's a lot of small nitty-gritty things that need to be determined before regulated entities can transact in these types of transactions in these derivatives. And specifically, this guidance addresses everything from how are virtual currencies managed, reported, who's responsible for what are the disclosures that need to be made, and importantly, also the accounting component, so people understand what their capital charges are going to be. So in the world of crypto, most people don't think about these things because they just want to hop on a market and trade. And I think that by being thoughtful and taking our time and the commission doing their homework, we now have an advisory that actually answers quite a few of these questions for us and puts everyone in the market in a position where they can start to offer these products to their clients.
Thank you, Tom. And before we go to Gary and Todd and Jay, I'll just ask you, the section 2 appears to be a very important section. Can you briefly touch on that section of the guidance?
Well, section 2 and section 3, I think I'll focus on 3, where it talks about custody and insurance. There are some comments in there that I think are accurate statements of fact, but maybe not up to date or thoroughly accurate with respect to describing the situation here in the U.S. Specifically, there's reference to theft or impairment of access to cryptocurrency, and certainly of late we've seen that take place in non-U.S. spot markets such as OKEX in China. We've seen theft over the last few years, but if you look at the U.S. markets, spot specifically, but of course the supplies at places like ErisX where we have physically delivered derivatives as well, you really haven't seen that. And I think you haven't seen that because the CFTC does a pretty thorough job of ensuring that DCOs like us have in place the appropriate safeguards and systems to manage these things. I'm certainly not stating that's a CFTC endorsement of what we do. I'm simply stating that there is a high degree of scrutiny. And I think what you'd find is that DCOs such as us have to build robust systems that have securities and backstops. And the comment about insurance, I would respectfully disagree with. If you have a strong system and you're utilizing regulated counterparties, then acquiring insurance is certainly a process, but I am not aware of any challenges for ErisX, nor some of our contemporaries in accessing insurance markets. So I think those are two things that are right to point out to think about, but I want to add context and color that these issues really are addressed and or are less of less import when you're dealing with regulated entities here in the US.
Thanks, Tom, for that
Sure.
answer. Gary, you've been tracking these developments legally for a while and interested, and I know you have a lot of thoughts about this advisory.
Sure. Well, to me, this is a remarkable advisory for a couple of reasons. Most importantly, because it effectively makes the handling of cryptos that are used as margin by customers in connection with futures and cleared swap customers, in connection with physically deliverable futures contracts or swaps on DCMs or CEFs, it makes the handling of that virtual currency part of business as usual. And I think that's a major, major situation. It's effectively saying that there is a home for the use of virtual currencies in obviously a very narrow circumstance, and we can apply the normal CFTC rules. And that's the significance of that at a very high level. The other thing that's very, very significant for FCMs is always has been a debate that if, in fact, an FCM, which obviously is under the CFTC and within the CFTC realm of exclusive jurisdiction, there's always been a debate as to whether, if, in fact, FCMs handle virtual currencies, the spot cryptocurrencies, whether that somehow might defeat the exclusive jurisdiction and throw FCM to a potential situation where they've got to be applying for money transmitter licenses at the states. And I think that what the CFTC has done by saying, no, this is all within, this is in connection with physically deliverable futures or contracts or swaps. This is all going to be, normal 4D kind of margin and protected funds. What they're effectively ensuring is that there'll be real, protection against any challenge that somehow FCMs handling spot currency, virtual currencies are somehow subject to money transmission rules. So I think that's very, very, very important. And again, the CFTC has framed this advisory all within the context of business as usual. They've talked about the fact that first and foremost, segregation is very, very important in the futures industry. That's the bedrock of customer protection. That when an FCM holds client funds, those funds must be held in the segregated environment. Can't be mixed with the proprietary money except under very restricted circumstances and residual interest, things like that. And you can't use, one customer's funds to satisfy the obligations of another. And they said, acknowledge that the virtual currencies that are used as margin in connection with these physically deliverable contracts can fit within that environment. That's a good check mark. The second check mark, and again, it's a good check mark, the CFTC said, let's always think about the bankruptcy of an FCM. Let's always think about a worst case scenario where maybe one customer blows up, the FCM doesn't have enough capital, there's got to be prorated distribution potentially among the different customer funds protection buckets. Can the fact that the FCM touched virtual currency work within that environment? The CFTC said, yes, it can. Check mark. So we're check mark on fundamental ongoing customer protection. We're check marked on bankruptcy. And then the CFTC also said FCMs have to have a risk management program. They've got to on an ongoing basis under 1.11. They have to have policy and procedures for evaluating liquidity, marketability, and mark-to-market valuation of all non-cash assets held in segregated funds. They've got to have procedures to deal with liquidating non-cash margin in a timely fashion without a significant impact on price. And again, what they've said is virtual currencies can fit within that environment. check mark. So the CFTC identified what was important to it and basically came up with a scheme to allow the use of virtual currencies in connection with physically deliverable contract, and basically said, if you comply with these processes, you're aces, you're home, you're okay. And so what are some of these circumstances? And by the way, what wasn't addressed in this advisory was customers trading on foreign markets or the treatment of virtual currencies held by an FCM as a result of proprietary trading, among other things. So the CFTC basically said, if you comply with the restrictions, we're going to allow you to take virtual currency as margin, and that's a good thing. So first and foremost, what's the most important thing? The exchange has to allow virtual currency to be used as margin for the relevant physically deliverable contract. That's sort of very important for this process. And then what are some of the, and then to do that, what are some of the obligations? Well, the FCM has to deposit the virtual currency in any one of initially 4 potential depositories: a bank, a trust company, another FCM, or a clearing organization that clears virtual currency. So those are acceptable depositories. No, not really very different than anything else that happens. There's an interesting footnote that says that potentially FCMs can themselves custody virtual currency, but the CFTC made it clear they don't expect that at this time. So I already saw a question. Is this going to be hard to do, or is this something that that somebody else can take care of for us? And of course, the answer is somebody else can take care of it for you, namely one of those other depositories, including a clearing organization like ErisX. So what's the next step? At one of these depositories, you've got to have an account saying that it's customer funds, and you've got to get a traditional acknowledgement letter from the depository, not from a clearing organization in the normal course, because that's accepted. But the other depositories, yes. Again, ordinary business as usual. The virtual currency that is deposited at these depositories has to be available for withdrawal upon demand by the FCM and available without delay. Delivery must occur ASAP, but no later than 1 day. Again, ordinary, boring, 1.20H, the kind of stuff that has to happen with any kind of depository deposit. There'll be some special accounting treatments that pertain to this, and our colleagues will discuss that a little bit later. But again, another important thing is that the virtual currency that's deposited will basically serve one purpose only, and that is to meet the collateral requirements for the relevant physically deliverable contract. So if you've got Bitcoin in SEG, that could be used to settle to satisfy the margin obligations of the physically deliverable Bitcoin contract. If you have Ether, it can be used to satisfy the margin obligations in connection with the Ether contract. It can't be used to offset other debits or deficits in the client's futures trading in T-bonds or gold or anything like that. It's a little bit limited use. So that's a little unusual for this asset. But again, this is CFTC is taking some baby steps in this area. The FCM, if it has its own Bitcoin, it can't top up the account, the residual account. Obviously, FCMs are familiar with topping up customer segregated funds to deal with liquidity issues and things like that. They can't use Bitcoin. They can't use Ether for that. The FCMs can't invest customer funds in crypto, 1.25. They can't do anything like that. It's not a permitted investment. So no repos, nothing esoteric. The FCM can take the crypto, it can deposit the crypto, it can use the crypto to satisfy client obligations in the relevant physically deliverable contract. And the customer just can't leave balances lying around. So the deposited crypto has to, again, have a correlation to the virtual currency contract that it's being used to support. If the customer stops trading crypto in a 90-day period, then effectively the FCM has to give notice to the customer and has to return the crypto to the customer by the end of another 30 days. So effectively from the beginning of the no trade period to the end, 120 days, but there's a look back. Again, to make it perfectly clear, although an FCM can't apply the crypto lying around in this account to debits or deficits that the customer may have in unrelated products, if there is something that goes wrong with the customer, a default situation, absolutely the FCM can use that crypto as part of the customer assets to make itself whole. So so there is, it's not like it's totally not useless. There's some special notice requirements that have to pertain to start and make this whole facility available. You got to give customers 45 days notice, and the CFTC suggests that you might be subject to a bit more examination if you get into this, but what that means, it's unclear. I do want to point out that folks, FCMs that want to take advantage of this opportunity and want to accommodate their customers, there are still NFA disclosure requirements under interpretation 9073. There's effectively a disclosure that's made if the FCM is handling derivatives contract. There's an FCM disclosure that's made if it's handling spot contracts. The language may not be 100% applicable to what's being contemplated now by the CFTC and entities like ErisX. I have been in discussions with the NFA as recently as this morning, and this is something I'm going to be looking at to see, how exactly it's going to play out. But again, the disclosure language is out there today. You can use it today to get into this business. You may take a conservative view and actually issue both disclosures that are required by the NFA. But watch the space. But there's no reason to delay because the rules are out there today. So those are generally some of the requirements that are out there. And obviously we can discuss more specific ones in response to specific questions.
Okay, Todd and Jay, I know you have some thoughts on this, and we'll turn it over to either one of you that wants to start.
So I sit on the AICPA working group for the accounting and auditing of digital assets, and we have spent a lot of time working on a tremendous number of issues in this space. You'll see that we start off with question number 13. There are 23 questions that we have answered as an AICPA working group. Those can all be found at AICPA.org and look for the Digital Asset Practice Guide. And we'll go through these at a high level. They have a lot of examples in here as to what you can do, how to think about these things. And we're really focusing here today on the broker-dealer guidance that was published, I think, just about 3 weeks ago. And speaking to that, I think as we've been working through this, I think some of the challenges in this space that now really have been clarified is that interaction between the accounting and the CFTC guidance. And so now that we have the CFTC guidance, and Todd and I will go through the accounting guidance, you start to get the clarity of how this is all supposed to go about. You'll see here in a second, we'll talk about FASB and some of their guidance. As an AICPA working group, our objective was always to fit things into existing guidance, and the FASB to get to the wacky world of accounting politics decided not to take up digital assets in their next session to add more guidance in the space, specifically because the AICPA working group really had it covered. So certainly my opinion here is I think we will see most of the guidance coming through the digital assets working group. Maybe that's because I sit on it. And the FASB has really deferred to us. We as a working group have worked closely with the SEC, been involved with the CFTC, as well as a bunch of other organizations like the PCAOB to get all of this guidance done. All right, so let's get to the meat of it here. And I'm gonna kind of ask some of the questions. Todd is gonna go through the answers to those questions as we talk about this today. Start off at the very beginning, a broker dealer that is working in the digital asset space. How do customer assets show up on their financial space? Todd, do you want to talk about that?
Yeah, thank you, Jay, and thanks for having me today. Audit partner in the financial services group at RSM. I've been working in this space for a number of years now with Jay and staying in tune with what's going on in the marketplace. One distinction I want to make is for the audience today, obviously, is the guidance in this practice aid is specific to broker dealers, and a lot of FCMs are duly registered as an FCM and a broker dealer, so this will be relevant guidance to you. This guidance was also reviewed by the broker dealer AICPA expert panel, so it was kind of in conjunction with that working group as well. And FCMs, standalone FCMs that are not a registered broker dealer, will have to determine, kind of what guidance they can use by analogy. In this particular question, they came out and definitively said, consideration of whether the digital assets need to be on the balance sheet. And there is specific guidance that says it does not need to be reflected unless there's a fail to settle. And they're really pointing to, again, pre-existing ASC guidance and applying it to digital assets. For those entities that are not a broker dealer or an FCM, you kind of have to work through your own considerations as to whether you can use the guidance in 940, which is specific to broker dealers. There's actually a point on that in the practice aid that you can refer to and kind of work through yourselves. There's also similar considerations if you're a filer, an SEC issuer, and you want to use this guidance. It's advised that you reach out to the SEC on that point. Ultimately, when thinking about, because I do think this is probably one of the more important issues, if I'm the FCM, I'm the intermediary between the customer and the DCO, I need to go through an analysis ultimately to determine, do I need to hold on, do I need to reflect this on my balance sheet? And I like to analogize to, if you think about the net option value that an FCM, does not include in their GAAP financial statements, but includes in some of the supplemental SEG statements or customer-owned U.S. Treasury securities. There's an analysis around those, whether they meet the definition of something that should be on the balance sheet. These are all things that need to be considered from each FCM's reporting perspective, taking into consideration their relationship between their customers and the depository where the digital assets are ending up. So it's important for you to work through those considerations. So Jay, you want to move on to the next
Perfect. One? Yeah, let's move to our next slide here as we go through. I think we have 4 more questions, and that certainly establishes the base question here. So we've got the assets themselves. How do we recognize the revenue here in this space, Todd?
Specifically addressed in question 14, agency transactions similar to commissions that for the sale, and it's pretty straightforward. Again, they point to pre-existing guidance in 940, and you've got the FCM will have an established clearing agreement with their customer, and that'll kind of govern the terms of the recognition. But really, no surprises there in terms of recognition upon the settlement of the transaction.
For the most part, we've been talking about customer assets. I'm sure for many FCMs and broker dealers, they potentially are trading with their own money. So how does the proprietary trading piece kind of fall into all of this?
Yeah, and so this goes a little bit outside of the CFTC advisory, as it was specifically around the depositing of digital assets, customer digital assets, but an FCM or a broker dealer inherently could end up with their own inventory of digital assets. And again, guidance was provided pointing to pre-existing guidance that akin to securities, you would treat this as inventory and record it at fair value. We'll share a little bit on the fair value aspects of that. We wanted to highlight this just in case the FCM or broker dealer is considering putting this on their balance sheet. One aspect of it is if you do have it on your balance sheet, it is ultimately your assets. What is the capital charge associated therewith? As far as I know at the moment, there isn't clear guidance from the SEC or the CFTC on this matter. I've heard it being discussed. There has been a discussion point between the two entities for some time. What is the applicable charge? again, that'll be one of the pieces of guidance that we'll need from the regulators, hopefully in the future.
I think one of the interesting pieces here is, as we think about fair value, is this concept of a principal market, very different than other equities and commodities. So Todd, can you kind of walk us through how we figure out what the principal market is to mark our assets?
We wanted to highlight this one because it can be relevant in two ways. One, if you have your own proprietary inventory, which we just discussed, but also in the context of the CFTC advisory, it's requiring that the digital assets be recorded at fair market value in the SEG statement or in one of the supplemental statements for customer reporting. And so the question might be, well, how do I determine what that number is or what that amount is? And so again, kind of framing this in the context of pre-existing US GAAP and ASCA 20, the reporting entity, the FCM, will need to determine what their principal market is. They'll need to assess whether it's active, and they'll ultimately need to pull out observable inputs from that market to determine fair value. A principal market in the context that they have access to it, because they might not have accounts over at other kind of spot markets, if you will, to utilize as a principal market to come up with fair value. The suggestion at this point would be you could potentially rely on the market where the futures contract is ultimately being traded, as that market might also have an associated spot exchange, which you could then rely on for pricing, which I think is a valid conclusion to get to, since the futures and the digital assets and margining are all kind of associated in the same spot.
The last slide here, I think this is our last kind of question to go through here. I actually find this really interesting as we think about the differences between some of the classic markets, equities markets, or derivatives markets, and working in this space, because we're talking about, if I could pick Bitcoin as an example, it is a 24/7, 365-day-a-year market. There is no technical close of business. And on Easter Sunday at noon, if I want to move Bitcoin, I can move Bitcoin. So how do we manage some of these nuances, like a cutoff period, when there really isn't a classic end of day like we see elsewhere?
Ultimately, the reporting entity has to come up with what is their appropriate kind of close of business, but then needs to establish some kind of control to determine what if there's any potential transactions that existed on that final day after they've closed their books that should be taken into consideration. And obviously, digital assets can be a volatile asset with markets moving outside of traditional business hours, as Jay mentioned. So something that needs to be taken into consideration. And so it'll be the reporting entity's obligation to kind of take those transactions into consideration.
Yeah, and I think if we go to the next slide, just to wrap up that piece here, a lot of it is about consistency, right, Todd? It's not. I don't know that there's a single answer here. It's that you have a consistent answer, right?
Correct.
Hopefully this was helpful. I mean, it's I think kind of summarize, as part of being able to work in this space is the CFTC guidance, but then also to understand the accounting guidance that goes with it is really important. So thank you, Todd, and Scott, back to you.
Thanks, Jay. We've had, while we're on that topic, there have been a couple of questions that we've gotten, and we had some emailed to us earlier. One from Russell Levins and another one from Ray Kahn about capital charges. There have been discussions that capital charges are larger for this product than for other futures. I don't believe these products are included in the Basel III SACR grid, so unclear who will decide. Another way of asking the same kind of thing, will FCMs be subject to a capital charge should they take crypto as collateral? So Todd, I think we'll go back to you on that question. Tom, the next question is probably best for you, and this is from JB McKenzie from TD Ameritrade. Does this guidance make it necessary for the FCMs to manage and process the underlying virtual currencies, or is it acceptable for the clearinghouse to do so on our behalf?
The guidance does not make it necessary for the FCM to do it. As Gary indicated, DCOs are an acceptable location for holding the crypto, and certainly at ErisX, we've constructed our technology and workflows such that FCMs never have to touch the physical crypto. It all sits within the clearinghouse, and the clearing processes and operations flows mean that the FCMs do not have to touch it. So hopefully that's a substantial simplification that should remove some concern from FCM. So short answer is no, you do not. The DCO can do it for you.
Great, thank you for that, Tom. Gary, I think this is a good one for you, and this is one that we had prior to the webinar. The guidance included some language that excessively highlighted the risks related to cryptocurrency. But in fact, from the presentation today, the guidance is quite positive and within the current regulatory regime. I added that part. Was there a particular reason to include factors that appear to be negative on the first read? We've gotten a lot of questions about that.
This is a new asset class for regulators. They're obviously being very, very cautious as they develop it. Keep in mind that the first exchange and clearing organizations to be approved for these products just happened within the last couple of years. So they're just taking baby steps. There's obviously been a lot of hype about, as Tom mentioned in the introduction, about special characteristics, and we can debate whether there are or not. But regulators don't want things to go wrong under their watch. That's normal. So I don't think that I think that there's more business as usual within this advisory, and there's more recognition of business as usual than anything extraordinary. But I think the regulators are just being cautious. It's a new asset class. They don't fully understand it yet, and they're just trying to move slowly.
Scott, if I can add in here too, taking the broader view, away from just the CFTC, we're getting a lot of these questions answered. If we go back to the SEC FINRA letter from a year ago, one of the things that it said in that letter was, digital assets, I think crypto assets is what the SEC uses, says they should be stored at a good control location. And in the footnote, a good control location could be a bank. I kind of rolled my eyes a year ago and said, that's not very helpful. Banks can't custody these things yet. And here we go. We see the OCC pretty recently saying that banks can custody these assets. And so I think that overall, we're seeing all of the regulators, the CFTC being one of them, really start to get their head around what it means to work in this space. And Gary, to your point, I wouldn't interpret these things as negative. Maybe Scott, that was how the question was framed, but that they don't want things to go wrong on their watch. And I think we will continue to see probably through the end of December some more guidance coming out that broadly across a bunch of different regulators that kind of opens this up. I think there's been a lot of discussion about the travel rule that got updated. I think it was on Friday. Some good news in the sense of what the travel rule was saying, some bad news in the sense that they were lowering the threshold down to $250. So I'm very optimistic from a regulatory standpoint because we're getting a lot of clarity on paper. And I think that we will see the ability to work in this space over the next months to years continue to open up.
Thanks, Jay. Good answer. And I think for those who have not been tracking this closely, the CFTC has been really the sharp end of the spear on a lot of these digital asset issues and really out front. And when you're out front, particularly in the government, there's going to be some pressure to not get too far out front and ahead of your other regulators. So they've done a real good job, and we view this as question asked and question answered, and there's some belt and suspenders on it, but obviously moving very much in the right direction, and think this is a significant impact, have a significant impact on the industry. Tom, kind of a backup question for you that I should have asked earlier. There's been a lot of exchange activity in this space, a lot of it offshore, a lot of it not regulated. The U.S. regulators have started cracking down. Your model, and there are others in the U.S., but your model is built to be more of a traditional model and fit into a regulated model where you use intermediaries and you clear trades, et cetera. What does this guidance mean for your exchange?
The probably most intriguing and interesting thing about crypto is the variety of models that have popped up for access to products, be they spot products or derivative products, with mixed and varied results. In the US, we've really only scratched the surface of what could be offered. And from my perspective, having a traditional capital markets background, having come from an FCM, I know the challenges that are involved, and the team here at ErisX knows. And if it were as simple as creating the technology stack, which is by no means simple, and turning on the website and saying sign up for business, which is essentially what you see happening in many of the non-US locations, sometimes referred to as unregulated, lightly regulated, or what have you. We know that approach leads to bad outcomes, as evidenced by some of the action being taken by the CFTC and DOJ recently with BitMEX. So for us, the long game here is, and will continue to be, demonstrating that access to these innovative products can be provided through traditional channels, allowing investors, speculators, hedgers, all the traditional market participants you see in a true commodities market, allowing them to access and get exposure to crypto in the ways they already know and understand. More importantly, through the workflows and protections they already understand. And I think the integration over the long term will allow for the creation of new products. Derivatives have been an invention that have allowed for fantastic growth of everything from physical commodities to financial indices. By bringing crypto into that framework, we know that the innovation that's pent up right now will be unleashed. So we're super excited to get past this step and get the guidance and this advisory so that we can get down the track further with FCMs so they can make these products available to their customers with confidence.
Thank you, Tom. Another question maybe for Jay or Todd. Now that we have the guidance, is there more to do for finance and accounting departments to accommodate customers trading virtual currency futures?
The guidance is always written in the most generic form as possible. That's the unfortunate part, right? And so now each of the FCMs or broker dealers or anybody working in the space needs to go say, how does this apply to me, and what should I do? And I think where the CFTC guidance and the AICPA guidance really come together to emphasize the right way to do things is really around custody. And so the CFTC is really driving to, and we were talking about this before, right? The CFTC says it has to be a good custody location, and we were talking about, who can do that custody, and the clearing organization can certainly do that custody. But where you can run into trouble, which the CFTC guidance says you can't do anyway, but where a generic broker dealer might run into trouble is lending customer assets out the door, and that switches from an off-balance sheet asset to an on-balance sheet asset. And we've seen, as some entities have come into this space, not really thoroughly thinking about all these little nuances until it's late in the game, and they actually have to put these things on their balance sheet. And so kind of doing that analysis up front and thinking through it, I think makes a lot of sense. What we've walked through today from an accounting perspective, what Gary walked through today from a CFTC perspective, really set you up to do this in the right manner. I think the CFTC did a good job of that. And so I think you're generally in a good spot. Any of the hedging that Todd and I do are generally because it's facts and circumstances, right? We have to get to the nuance of what the entity is really doing and make sure that they can or are meeting the essence of the guidance. Todd, anything I missed there?
Thanks, Todd. Gary, I know you have some views on that, so we'll go to you and ask for your opinions.
Yeah, again, I just think it's important to stress how much business as usual this is. The CFTC has really set out a very, very clear path that as a former FCM guy, it's very easy to follow. Open up an account at a clearing organization, make sure the account is properly labeled, they've given very specific instructions how you account for this on the seg statement. Report the virtual currency at fair market value on line 1B. They're very specific. Net ledger balance, securities at market, and on line 12, segregated funds on hand. They've given you very, very cookbook type entries, and at the end of the day, there isn't a lot of heavy lifting other than the fact that there are you only can use these virtual currencies for very, very limited purposes, but other than that, this is really very business as usual, and there's nothing that should come as a heavy lift for anybody who's going to take advantage of this.
Tom, another question for you from Ben Miller. FCMs have established workflows within their futures back office systems. Is ErisX integrated into those systems as of yet?
Short answer is yes. We're already integrated into the FIS suite of products, ClearVision, Ubix, and Telematch. If I'm forgetting one, it's my apologies, but yes, we've already integrated into those. For FCMs that perhaps are on other systems or are looking to get live as quick as they can, we have built into our clearing platform most of the functions you'd expect. And this is going to sound boring and uninteresting to most people on this call, but if you've only dealt with the non-US offshore crypto derivatives exchanges, we do crazy and innovative things here at ErisX. We produce PDF reports at the end of the day. We put up files with your trading activity. We can produce statements and all the things that you'd expect from a traditional DCO. That is not the case with the offshore non-US location. So we've built a lot of that functionality into our system to provide all that, but we are fully integrated into the FIS suite and obviously have all the data integrated into homegrown solutions as well.
Coming from RSM, very exciting to hear about PDFs and things like that. To kind of echo what Todd was talking about, I think that is what's so important, is that integration to standard systems, and certainly makes our job easier when you're working off an Excel spreadsheet. And so that integration to be able to get the finance function to really understand and use the normal processes that they use is key here.
Gary, this is one for you. If FCMs hold spot virtual currencies for customers as contemplated under the CFTC advisory, will they potentially also be required to obtain state money transmittal licenses or New York bit license?
To me, that's the most exciting aspect of this. As someone who's been advising clients for quite some time now in this space, the tension between money transmission and bit license, and soon to be the Louisiana Virtual Currency Business Act compliance, is just a nightmare. This should all be within the exclusive jurisdiction of the CFTC. It should forbear any obligation to deal with any state issues whatsoever.
Gary, I'll say that Eris also runs a spot market as well, and we have an excellent relationship with the 50 states and territories where we're regulated, including New York, where we have a bit license. And I know there's a lot of talk about putting spot completely under the purview of the CFTC. I'd say the state level process, although certainly frustrating for some folks, it works. And the state regulators take their obligations very, very seriously. And moreover, at least with ErisX, we've put in place a model where we can work with FCMs either on an agency or principal basis. There's some small variances in a few states there to offer spot as well. And the upside for them doing that through one venue and one clearinghouse like ours, and we operate our spot market the same way as a futures market. We have a separate exchange, separate clearinghouse, is that now you have the basis and the derivatives in one place, and it simplifies collateral management. But that's the sort of technical and operational and trading benefit. But I think we should step slowly into the conversation of suddenly now physical spot markets being regulated from the get-go, as opposed to the CFTC leaning into those markets when there's malfeasance or other bad actions. I know the state process is frustrating for some people. It's getting better and it works. We have a very vibrant market of spot market providers in the US. So I think it's a little bit unfair to say it just has to go over to the CFTC in its entirety. And I know you and I could talk about this for a long time, but just wanted to share that particular point of view.
Another question for you: as an FCM, do I need to manage private keys, have a wallet, hardware, software? Will I need to interact with the blockchain?
Short answer is no. By being the DCO where the virtual currency assets are managed, you do not need to have any of those things at ErisX.
Gary, one question for you, and more of a high level question. What are the next steps for FCMs? What changes need to happen before FCMs can start accepting crypto as collateral?
Well, let's talk about FCM BDs. I know there's always a curiosity as to what might role FINRA play in this. Keep in mind that the only role that FINRA should be playing in this, because all the activities are going to be overseen by the CFTC that we're talking about, but notwithstanding the FINRA has a bunch of advisories out there, 1820, 1924, 2023, which basically if you're touching crypto, they want to know about it. There should be no CME or CMA required in connection with getting into this business, but you should let your FINRA folks know if you're going to do this as they've requested in those notices. As far as getting into the business, as I discussed, you've got to give your clients 45 days notice that you're about to make the services available. You've got NFA disclosure obligations under the interpretive guidance 9073. And then you've got to, obviously get the account set up with the right naming convention. And then you're good to go. It's really no different than starting any other contract. Most of the lift is on the operational side, just to make sure everything is working well and that things flow through to your accounting. But from a legal and regulatory perspective, there shouldn't be a heavy lift.
Jay, I want to go to you and see if I know you have some closing.
Yeah, and to kind of, I think Gary put it really well at the end, right? This shouldn't be a heavy lift. You caveated it shouldn't be a heavy lift on the accounting perspective. I think that really it shouldn't be. It comes down to having that conversation with your auditor and doing that upfront in advance. And sitting on the AICPA working group for digital assets, I have worked with representatives of the Big Four and other firms as well. So we are all now on the same page. I think that's really important here. I would love for you to call us up and ask for help, but everybody should be talking the same nomenclature here. And I think it is really important that we all kind of work together to get this done. Last, just nuance here as we close this up. For the most part, we've been talking about virtual currencies, those that the SEC has designated as not securities and therefore managed by the CFTC. I am sure you will see lots of weird things out there that may or may not be securities, and that's really not what we're talking about here today, and certainly not what the accounting guidance was set to cover.
Thanks, Jay. Gary?
I just saw a question come in from an anonymous attendee. I think I know that person well, Mr. Attendee. As there are no FCMs on the call to give their point of view, anecdotally speaking, what are you seeing in terms of desired demand by the FCMs to actually implement these margin funding solutions? I'm going to take that answer from a different perspective because, as I said, we do advise a lot. We advise exchanges, clearing organizations. We've had the pleasure to work with ErisX, people who trade. And people have asked me, is there anything during this COVID epidemic that has struck me as unusual? And I would say yes, but it's not because of the COVID epidemic. It's because of the interest rate environment. We have seen money managers looking for alternative asset classes. And one of the asset classes we are seeing folks get into right now is crypto. Folks that 2 years ago would have sworn on a stack of Bibles that they would never touch this stuff are now actively trading. One of the things they struggle and we help them with is to navigate relationships around the world at some of the spot exchanges. The idea that they now can handle deliverable crypto through an FCM in an environment that they are comfortable with, the 4D environment, is really significant. It is highly significant because their CFOs understand the SEG environment. They understand doing business with an FCM. They understand doing business on a DCM through a DCO. That's something they understand, and it makes them feel more comfortable, and it allows the traders to push a product internally that might have been a little bit more concerning just a couple of months ago. So whether the we hear from FCMs all the time. And my guess is this is too soon to see how people react to it, but I think there will be a lot of interest. But there should be a lot of interest because I think you're going to be hearing from your clients, FCMs, that this is a product that people want to trade and they want to use spot cryptos as margin.
Thank you, Gary. And Tom, I'm going to turn it over to you last, and I'll say this before. Thank you, one, for hosting this event. We had a lot of participation, a lot of questions, and a lot of just attendees. So people are obviously interested in this. I'll take what Gary said just one step farther. Just since we've been working very closely with the commission on this. When this advisory came to the commission, we had multiple phone calls from commissioners saying, "Is this good? What more should we do?" And so I think I don't want to put words in anybody's mouth or lead anybody down the wrong path, but I do think the commission at the highest level is very interested in continuing to be the sharp end of the spear and allowing for innovation. And you hear that every time the chairman speaks and when commissioners talk about this. So I think that is a really good sign from this. And Tom, I'll give you the last word.
Thanks, Scott. Yeah, I'd agree. The pace of development in crypto is like nothing I've seen in my almost 25-year career in capital markets. I really have never seen anything move at this pace. And I think it's for a variety of reasons, some of which Gary touched on and others. Just people want exposure. They're looking for a differentiated asset class to trade for a whole variety of reasons. And that differentiation of reason will lead to a really robust and active trading market. But for that to work, you need to have the right infrastructure in place. You need to have the right regulation in place, and you need to do all of your homework. And if all the attendees today take anything away from this, is that we have a whole variety of people on this call. We have FCMs on this call. We have law firms on this call. We have trading firms on this call. We have technology providers on this call. We had everybody on this call. And what you should take away from this is that if you want to offer these products to your customers, doing it under the CFTC auspices, with the DCM, with the DCO, through workflows you already know and know how to process, this will be the fastest and safest way for you to offer these to your customers. And the CFTC is working very hard. If anyone's been on any webinar in the last 2 or 3 weeks, it's impossible to go on and not see Chairman Tarbert talking about how important he sees the development of crypto in the US. And I think the agency, the commission under his guidance has done so much work this year, certainly with ErisX, but with others, and of course, advisors like this that apply to the entire market to really move this forward. So I realize the pace of innovation isn't the same as an unregulated offshore exchange running God knows where, but the pace here has been pretty quick. And now we're getting all those elements in place. And with this, we're ready to go. So we look forward to continuing the dialogue individually or as a group. We're going to take some of the questions we got via email and in the chat that we didn't get to. We'll package up answers to those, and next week share with you the recording and share with you answers to those questions. But it's great to be innovating here in the US under this framework. There's so much here to be positive about that I want everyone to walk away knowing that, and that's what we feel here at ErisX. So my thank you to you, Scott, for emceeing, to Gary, Jay, and Todd for your words and your preparation. So important to be ready and make this useful time, and I thank you for taking the time and effort to do that. And thank you to all of you for attending today. Welcome to the ErisX Insights presents Crypto for FCM Customer Accounts. For those of you that enjoyed the webinar last week, thank you very much for attending. And for those that did not, I hope you enjoyed watching the recording. We've gone ahead and created this after-party video to address many of the questions that we received, some during the webinar that we felt would benefit from
additional clarification, and others that unfortunately we were unable to get to. I'm grateful to everyone who attended. We had fantastic attendance from a really wide and deep variety of industry participants, which tells me that the hard work that's been done here to get this clarification from the CFTC that will now enable FCMs to move forward in offering virtual currency futures that are physically settled was something people were waiting to hear. So with that stated, again, I'm Tom Chippas. I'm the CEO of ErisX. I'm joined by Lori and Christia, our general counsel, and Lauren and I are just going to go through some of the Q&A that I've referred to here, and we hope you find this of value. Let's get to the first question. Lorian, what does this advisory mean for regulated exchanges like ErisX?
I think as a starting point, this means that the guidance made clear for FCMs that FCMs can deposit or keep virtual currencies with DCOs such as ErisX. Effectively, what the guidance does is it provides a very clean roadmap for FCMs how to comply with the CFTC regulations for virtual currencies. And it provides a roadmap for FCMs to know that when they will be audited by their DSRO, whether NFA or CME, they know what to do to comply. They know what to do from a balance sheet perspective, from a SEC statement perspective, and they just need to know, they need to tick the boxes in the guidance to know and feel confident that they can offer virtual currency futures to their clients.
I think the clarity is really something people have been waiting for, so super helpful to have received that via this guidance.
I agree.
Does this guidance make it necessary for FCMs to manage or process the underlying virtual currencies, or is it acceptable for the clearinghouse, for example, to do so on behalf of the FCM?
This comes back to the first sentence I said in the last question, qualified depository. The guidance makes clear that an FCM can hold virtual currencies at a qualified depository, and effectively the qualified depository, such as ErisX, the DCO, can process and handle the virtual currency in all respects. So no, the FCM does not need to handle and process the virtual currency itself. The DCO, ErisX in this case, can do it for the FCM, such that the FCM never has to touch it.
As an FCM, would I need to manage private keys, have a virtual currency wallet, be it hardware or software? Will I need to connect to these public blockchains? Any of these sort of actions that typically are associated in your mind with blockchain and cryptocurrency, will I have to touch or manage any of these specific items as the FCM?
No, I think it comes back to what I said before. An FCM will not need to do any of these things. In fact, ErisX does all of these things on behalf of itself and the FCM, and we are audited regularly and checked regularly by our regulator to make sure we're doing this in a compliant and industry standard way.
I'd agree. And I'd add, for the convenience of FCMs, all the data underlying the virtual currency balances, as well as, of course, fiat and futures positions, are all accessible in traditional user interfaces, reports, and APIs. So the processing all happens on their behalf, but they can still get the latest information in real time.
Yeah, Tom, I think the solution that ErisX developed was very elegant. We had this workflow in mind in developing it, and I think FCMs would be very pleased.
If FCMs hold virtual currencies for their customers, as contemplated under this CFTC advisory, is there a potential that the FCM may also be required to obtain state money transmission licenses, or say the New York State virtual currency or BIT license as well?
I think this is a really important question. I think this is why Gary drilled down on it in the webinar. When you talk about virtual currencies, you hear a lot about money transmitter license and the New York BIT license. And I think Gary's point, and I want to clarify or make it abundantly clear, futures trading is preempted by federal law. Anything in support of futures trading, from funding accounts to money transfers, is preempted by federal law and does not require state money transmission or a New York BIT license.
Thanks for that. That's one that we had from a few people And I know we talked about it at length in the webinar, so thanks for clarifying that.
So Tom, having discussed the legal and regulatory aspects of the CFTC guidance, what steps should FCMs take next to accept virtual currencies to support futures trading?
Well, Lauren, I think there's a couple of things to consider there. Let's start with an easy one. The advisory very clearly states that FCMs need to provide 45 days notice to their customers that they're going to be offering trading in virtual currency futures. And important to note that by holding the virtual currency at a qualified depository such as ErisX, the FCM won't be burdened with any additional capital impact. So the FCMs can follow the CFTC guidance for reporting, and of course guide their respective DSROs in their joint audit program for the appropriate reporting.
And to drill down on this a little bit more, do FCMs need to make any technical changes to support this?
Not really. So in order to ensure that FCMs may process the virtual currency futures via their existing back office workflows, ErisX has worked with FIS to make sure that data from the exchange and clearinghouse will be fully supported by the FIS suite. We actually completed integration and testing back in September of last year, and ErisX's derivative products will display alongside the traditional derivatives that FCMs offer, whether you're in GMI, ClearVision, or in Telematch. So the flow will be seamless into those products for use by the FCMs in their traditional workflows that they know and love today. And of course, Eris Clearing provides a whole variety of tools for FCMs to view information, get reports, and manage all that with the mature entitlement and access controls that one would expect. But bottom line, the data flows into the FIS suite. It flows through those systems in the regular way. And if you're not a customer of the FIS suite, if you're using another product, say from Ion or Homegrown, our back office systems in Eris Clearing provide file transfer, provide API access, all the means you'd expect to integrate that data into your back office, allowing you to manage these just like any other future.
What the guidance makes clear is that virtual currencies themselves can be used to first collateralize virtual currency futures. The virtual currencies cannot be used otherwise to collateralize any other contracts. And segregated customer funds cannot be used to invest in virtual currencies. The letter the CFTC guidance is very narrowly tailored to allow FCMs to facilitate trading in virtual currency futures, such as the ones offered at ErisX, but it really doesn't go beyond that.
Got it. I think it's super tight and clear, so that hopefully makes it simple for FCMs to manage internally, and of course explain to any interested parties that perhaps respond to that 45-day notice that they have to give about how the FCMs are managing and using those virtual currencies. So I think this is a good example where less is more. It's very crisp and succinct.
I agree.
Lorian, thanks for answering all those questions, and I appreciate everyone taking the time to listen to this additional recording of new questions, and for those of you that went through the webinar as well. There's a lot of content there. If we can provide any additional information or connect you with folks that presented on the webinar, do reach out to us at events@erisx.com, and we'll make sure you get the proper connection made. Thank you for your time.